afternoon, everyone. I'm Pamela Hastings, and welcome to another Barometer Tuesday webcast. Joining me today is David Burrows, Chief Investment Strategist and President here at Barometer. And on this webcast, we'll provide you with a brief macro overview and take a look at the market in the sense that it has been a bit wobbly over the last few weeks. And David's going to dive into, especially the last couple of days, how that's been working and working with specifically the themes that we're invested in. David and I would be pleased to address the questions at the tail end of this conversation. So don't be shy. Please email me at phastings@barometercapital.ca or hit me up on the chat via the Zoom link. And with that, I turn the conversation over to David Burrows. Good afternoon, David.
Hey, Pam, how are you? Good to see you.
Great. Always a pleasure to see you, David. Looking forward to this webcast.
Great. Well, thanks everybody for joining us today. I've had a few calls over the last 7 or 10 days asking about the fact that some of the internals in the market have been a little bit sloppy. Some of the themes that we've been focused in have been consolidating. And one of the questions that is, I think, on everybody's mind is the Delta variant going to cause a bump in the road sitting here in the middle of August? Are we headed into a difficult seasonal period? And so I want to kind of dive in sort of through our lenses and take a look at some of those questions as we go through the call today. So I'll move along fairly quickly. Some of the stuff we've been talking about for a while, but we just want to continue to see progression and movement forward. So just to kick off, as we always do, from a very high level, we think that the structural backdrop continues to be quite constructive. We think we entered a structural bull market in equities in 2013 in the Dow and the S&P when we exceeded the highs from the year 2000, much like we did in 1981, exceeding the highs from 1966, the end of the last structural bull market. And we've been in this market working its way higher with interruptions since then. So that's 8 years. And these things, as you can see, tend to go on for quite some time. So we got to keep in mind that despite the fact that we continue to make new highs, this can go on for a really long time. We take the S&P and take a look from 2013. We've been marching our way higher, correction through 2015-16, correction in 2018. Frankly, it was a bear market that happened in about 2 months. We had a very rapid bear market at the beginning of 2020 as we headed into coronavirus, and we've been working our way higher since then. When we take the NASDAQ 100, NASDAQ 100 actually broke out of its bear market in 2016, and the market has been working its way higher since then. And if we were to take the value line arithmetic index, it really only broke out of the range that it was in going back to 1999 in 2020. So bear markets can go on a really long time. And we always highlight that the most important skill in a bear market is being a good seller, because what is weak can get a lot weaker. But in a structural bull market, we want to hold our winning positions as best we can, so long as leadership is intact. In the fixed income world, we went through a shift in 1981 when rates peaked and rates fell consistently from 1981 with short interruptions. Until I think we saw the generational low in the early part of 2020 when the 10-year Treasury bond traded just below 50 basis points for the next 10 years. Yields have been going a little higher since then. We think we saw a structural bottom at that point. And when we look at the commodity asset class, commodities were in a bear market, certainly relative to stocks in an absolute price going back to 2008. And we think we went through a bottom last year as we sort of came out of a disinflationary period. So we'll continue to test those theories. But as we move along, things continue to look that way. This is the Commodities Index, which is an equally weighted basket of commodities, both agricultural commodities, metals, and so on. And they broke the downtrend at the end of 2020 and have been slowly, month by month, working their way higher. Certainly we're now in a point where they've been consolidating a little bit. We'll look a little bit closer at that over the course of the webcast. On the S&P in the near term, since the correction in September and October of last year, the S&P's really been in a very, very, very tight channel. But you can see a number of times we've tested the 50-day moving average, holding each time, which is sort of the first line of defense, and working its way higher. And again, last week on Thursday, we came right down and tested the 50-day moving average and have been bumping higher over the last 3 days since then, back up into the middle of the range. We take the NASDAQ 100. NASDAQ 100 has been in that same channel going back to last September. We did have a period between sort of February and the middle of June where the NASDAQ consolidated and underperformed for the first time in a long time, but then reaccelerated and worked its way higher. Here we close at a new all-time closing high today, driven higher by a lot of the biggest NASDAQ stocks, software in particular, and in particular, cybersecurity. The TSX actually recently outperforming the S&P, made a new relative high versus the S&P today, probably driven by some of the sector weights that are different than the S&P. But again, it's been working its way higher really since October of last year. And so that's been participating nicely. Equally weighted S&P. Well, we went into a consolidation period in April. So the equally weighted or the average stock in the S&P underperformed the market cap weighted S&P, which is dominated, of course, by the very largest stocks. But then we finally broke out at the beginning of August. Last week, we retested that breakout. In other words, pulled back to the point we broke out. But again, today, closing at a new high. So good action in the indices, but clearly there's things going on underneath the surface of the indices that we have to take a really close look at. So let's talk about some of the leadership themes. Since March 23rd, 2020, the leadership has been quite clear: materials, financials, energy, technology, industrials, and consumer discretionary. So a combination of secular growth, large cap stocks with a predictable growth rate, things like Microsoft and Apple and Google, along with companies and industries that are economically sensitive. So that is investors trying to be positioned for a new business cycle that will invariably come and that we are in over the last year. The groups that have been lagging, the most defensive sectors, the sectors that do well during falling interest rates, real estate, healthcare, utilities, and consumer staples. So we want to continue to test, is the leadership continuing to be in the economically sensitive groups plus large cap secular growth? Can they both coexist, which has been the case? Or can we see the defensive groups start to play catch up? Let's take a look. So the big drivers in the market over the last 18 months really have been the bond market and the US dollar. The US dollar peaked out in March of 2020 and then began a long decline. And that really marks investors' willingness to sell a safe haven asset and put it into something that has more risk, potentially more return. It may be that it's investors saying they're printing a lot of US dollars, they're devaluing them. We may want to take those dollars and put them into something that will hold my purchasing power in the event that there is some inflation or reflation in the economy. Now, the US dollar weakened until early in 2021. And once that took place, went into a range where we basically have traded in a range since then. We've challenged the highs once and twice, both times getting rebuffed and rolling back over. So that's something to watch. A strengthening US dollar might indicate that we were getting more defensive in the market. People were getting more cautious, want to become safer. And then what does that mean for some of the riskier parts of the market, the things that are more economically sensitive? Well, probably when the US dollar bounced a little between June and August, that probably put a little bit of pressure on sort of more risk-oriented assets. The other key theme is the long end of the US bond market. So the 30-year bond in the US peaked in March of last year and effectively has been falling in yield since, put in again a low in March, April, and then corrected. I want to point out lower high, lower high, lower high, lower high. Now, effectively, if you took the decline from 179 to a low of just above 132, and then look at what's happened since, we've had a roughly 1/3 retracement of that decline. So that would be a very typical correction in a decline, 1/3 to 1/2. When we looked at the point and figure charts last week, we saw that the TLT bond ETF had rolled back over and was likely to resume its decline, because during the period where the bonds rallied from sort of March to August, we know there was tremendous inflows into the bond market. And once we get to the point where the 3-month flows are this extreme, it tends to be that the rally in bonds would run out of gas. And I'm guessing that that is likely the case. But when we looked at the yield chart on the 10-year bond, same thing, we saw a reversal in the direction of yields on the point and figure chart. Again, likely pointing to the fact that we've seen a short-term rally take place and run its course. So if the US dollar rally has run its course, and it may well have, and the bond market rally has run its course, then that should mean good things for risk assets. So we're going to talk a little bit about it. This was the decline in the TLT, a rally which was a portion of the decline, and a rolling back over in price. So we talked last week about the fact that during that time, flows out of cyclical sectors went from extreme positive to extreme negative. So that's a reset in the appetite for cyclical stocks. And let's look at see what happened to those stocks. Well, here's the value ETF. Value ETF put in a high in May, did pull back, a pretty shallow pullback, frankly. And here we are right back to highs. So a small reduction in that move higher in bond prices, a small moderation in the move higher in US dollar, and value stocks right back to highs. This is the XLF, the financials ETF, broke out of a range going all the way back to 2008 in the early part of 2021, pulled back into the moving averages and reversed higher. So it looks as though that correction in financials has run its course, specifically in the strongest areas, capital markets. This is the IAI ETF, again, pulling back to a near-term moving average. That's a 21-day moving average. And in the last 3 days, again, tipping higher. So financials would tell us that that correction in the bond market likely is over, highly sensitive to long-term interest rates. Let's look at materials. Corrected from middle part of May, hit the long-term moving average, broke out of that range, and again, after testing the 50-day moving average, turned back higher, likely pointing to the fact that the rally in the US dollar may be running its course. People again stepping out to buy riskier, more economically sensitive sectors with the belief that we may be headed into a reacceleration. We look at some of the basic materials. Aluminum, after having broken out, consolidated and moving higher. Nickel is the same picture. We've talked about copper in the past. It's had a similar consolidation and turning higher. Basic materials looking quite attractive. This is steel. Steel correcting from early May. This is steel stocks breaking out, retesting the moving averages and the breakout point and turning higher. Had an excellent day today. Nucor, Stelco in Canada, which is a very large position for us, Cleveland Cliffs, and really the whole group across the board. Even lowly gold, which had been through a bear market from 2011 through 2020, consolidated for several months, broke out of the range. Again, last week retested that breakout, but magically held and rallied. So basic materials continue to look quite good. And that means probably we head a fair bit higher because we've seen a sharp bump up in free cash flow in the materials producers. If the commodity prices remain strong, likely the market starts to reward these companies for that, and they've been sharply paying down debt. Industrials, another group economically sensitive, consolidated over the last few weeks, broke out of that range, held it nicely last week when we hit the lows in the market and turning back higher. Now, the one group that we talked about maybe being a concern was the NASDAQ. You had the S&P making new highs, but the number of new lows in the NASDAQ at the time when the S&P was making new high, we said last week, this is something we really have to watch. We either need to see a reacceleration in the NASDAQ, or we need to get more cautious with a concern that that could spread into the rest of the market. Well, after some weakness early in the week last week, again, NASDAQ, this is the IYW technology ETF, blasted off in the last 3 days to make a new high. And within that, semiconductors, which are probably the most economically sensitive group, held very nicely at the 50-day moving average and took off, and we're back virtually at highs. And then today, the cybersecurity companies, led by companies like Palo Alto and CrowdStrike, after testing the 50-day moving, blasted off and made a new high. So it looks to me as though the economically sensitive sectors, financials, industrials, basic materials, also many areas of consumer discretionary, are reaccelerating after having a break since the beginning of May. The technology sector corrected from the early part of the year through until May, and again took a breath and seemed to be reaccelerating at the same time. So perhaps secular growth and economically sensitive stocks can participate. That means improving breadth, meaning more choice, more areas for us to diversify. And that has been the leadership since the bottom of the market in March of 2020. So leadership appears to us to be intact. The consumer discretionary group, which last week was sitting at a tenuous point, this week reversed and virtually back at highs. So the story that the market is telling us is that there is risk appetite. The story that the market is telling us is that while the coronavirus and the Delta variant are something that we're thinking about, there are strong underpinnings in the market that are holding things together. The one area that continues to be a little bit sloppy is energy, but even energy, after moving lower late last week, is trying to rally back. We'll have to see where things resolve here. So momentum in general has reestablished itself. We've had perfectly normal corrections of about 90 days in the NASDAQ, about between 90 and 100 days in economically sensitive stocks. They happened at different times, so the index remained intact, and it looks like conditions continue to be strong. Let's look at some of the most recent data. The question we keep getting is this wave of the Delta variant going to derail things? I think it's good to see that per 100,000 people per capita, the number of cases in this wave looks like it's starting to decline, especially in some of the most affected states like Florida. It's very early days. We'll see whether that's something that continues. But we know that the R factor, okay, which is the average number of people who become infected by a person infected at a time, has dropped below 1. And that means that likely we're going to see case levels come down. We talked last week about financial conditions being the easiest on record. No tick up here. We talked about ISM manufacturing inventories hitting multi-year lows, meaning there's going to have to be an inventory restocking in the economy. That is very supportive. The initial jobless claims last week, once again, ticked lower, but still well above where we were before Corona, meaning that the Fed continues to have cover to try and accomplish their stated objective, which is get back to full employment levels. From an earnings estimate standpoint, as we got through the end of the quarter, 75% of companies beat estimates from an earnings perspective, and 78% of companies beat on revenues. It's the best results in several years. So given the fact that summer and early fall corrections tend to be led by the fact that you see revisions go lower, we're actually seeing revisions go higher, and the 12-month blended earnings per share expectations continues to work its way higher. Share buybacks that have been authorized going through the end of the end of July are working their way sharply higher, which means corporations are going to be back in the market buying shares. And aggregate global dividend increases, once again, is ticking higher. So all of these things are good for equity investors. For the RDVY, which is the Rising Dividend Achievers ETF, again, after consolidating, it looks like it's ready to have another step higher. If bond yields were to tick higher, dividend growth is the place you want to be, and dividend growth is significantly outperforming high dividend paying stocks, which are more defensive. A few key stats that we watch. Volatility. This was the spike in volatility early in the coronavirus, and each spike since then has been at successively lower levels. So we watch this closely for a sign that expectation for volatility picking up, but here we are sitting right down at the low end of the range. At the end of the day, we have to use our process to try to accomplish what we're trying to do in our portfolios. We aren't trying to be everywhere. We're trying to be targeted in leadership groups. We've got to use the tools that we have to try to identify the key themes to focus on in the market that have tailwinds where we're seeing expanding breadth. Of course, we watch every day for signs of change, new leadership to emerge. Say, for instance, if defensive stocks were to start to outperform economically sensitive, it's not the case. And if breadth were to significantly deteriorate, we have to be prepared to get defensive. It doesn't mean that if our breadth models turn down, we're going to go sell everything. But it does mean we'll tighten up our stop losses. And if we start getting stopped out of positions, the money goes to the sidelines. A great example of that would be that we've been stopped out of many of our energy positions. And that may end up being that they find a footing and start to rally again. You can always add positions back, but we'd far prefer to not let a little mistake turn into a big mistake. So it is a very tactical approach. As far as the sector weights go, not major change. They continue to be about the same. Financials being our largest weight. Technology weight has come up somewhat, but still well below market weight because we think there are great opportunities in industrials and materials and financials and some consumer discretionary stocks. Some things to keep in mind. I continue to have phone calls from people saying, how can the market continue to make new highs? These are some statistics on the European markets. In a structural bull market, you get a lot of new highs. In 1996, almost 50 new highs. In 1997, 65 new highs. So far this year, about 35 new highs. So if we have another 35 new highs over the course of the year, what might it mean for the return at the end of the year? I also get calls pointing out the fact that we haven't seen a 5% correction in a long time. But we know in a structural bull market, you can have really long runs. In the late 1990s, almost 400 days, 370 days in the early 1990s. In the 1960s bull market, almost 400 days. At 186 days, we're a long way from that. So we watch every day for signs of weakness. We watch every day for themes that we're focused in that might run out of gas. But at this point, things continue to be quite favorable. I want to leave you with a few bullet points on things that we think are supportive of markets. There's now $16.5 trillion worth of negative yielding bonds. So how happy do you think those investors are in a negative returning security? Only a small fraction of those assets, were they to move to equities, could have a big impact. The Fed continues to buy $120 billion worth of US assets a month. And yes, they may taper in the fall, but that doesn't mean they're taking liquidity out. They're reducing the amount of new liquidity they're putting in. There's over $4.5 trillion sitting in money market funds, getting zero. Roughly 30% of the stimulus checks are still sitting in deposit accounts and are yet to be spent. The 10-year US bond is yielding a real return of -1%. So the return minus inflation is giving a negative real rate of return. So all of those investors are losing money month by month. If you take all of the high yield bond market, it's averaging a yield of 3.97%. So junk bonds are yielding 3.97%. it's an incredibly low premium to be paid for the risk that's taken on. The lowest individual bond in the bond index, junk bond index, is paying 2.18% on a 5-year bond. So over the last few weeks, hedge fund managers have taken down exposure and sentiment has shifted. If we look at the AAII Bull Bear Index, if we look outside of 5 or 6 major events going back to 2012, bearish sentiment is as high as it's been. So we're talking about strikes on Syria, the 10-year bond falling below 2% for the first time, COVID, the flash crashes. There's been a lot of events, but sentiment is negative at this point. That means that we've seen money, excess money come out of the market. We've seen sentiment reset. There's a wall of worry. There's things that people are concerned about. Yet when we look at the behavior of the market, it continues to look resilient, and we look like we're seeing a reacceleration underneath the surface. So look, we watch every day. Things can change. We're always ready to make changes in the portfolio as it's required. But as it sits right now, we think that there's lots of liquidity, and we think that there's lots of good economic news to support markets. We will get defensive if things start to change, but at this point, we continue to be pretty fully invested. I'm reminded of a tweet that I have pinned at the top of my Twitter feed at Barometer CA. In a bear market, the most important skill is to be a good seller. And we've proved that that's important time and time again. But in a bull market, you have to remember the hardest thing to do is to stay with your winning positions. And right now, there's a lot of winning positions. So with that, Pam, I'm happy to take questions, and we sure appreciate everybody logging in.
Thanks so much, Dave. We do have one question here coming in from one of our investors, Stephen in Toronto. Speaking to the volatility that you walked us through this afternoon, his question is, are there any funds better structured than others to take advantage of increased volatility at Barometer, and why and how are they structured to be different?
Well, I'm not sure I understand the question, Pam. Can you just read it one more time?
Sure. Are any of the funds that Barometer has better structured to take advantage of increased volatility? Why and how?
Okay. So to take advantage of increased volatility. Well, the first thing I want to say is when volatility gets to the range that it's at now, it's probably the best time to be invested in risk assets, and it can stay low for a long time. 2016, 17 vol stayed at a very low level. We're still at an elevated level relative to that. However, what could we use to take advantage of vol? Well, certainly the macro portfolio that we have in 2015, 16 in a global bear market, got short emerging markets, got short energy, and was long volatility. And we had a very strong positive return against a very weak market. If we thought that volatility was ticking higher, we can buy units in the VXX, which is an ETF that is invested in a range of volatility futures, and use that either to hedge or to take advantage of volatility. But then, of course, we could also be short, risk assets in that same fund. As it stands right now, that's not the case. We're taking advantage, I think, of falling volatility and improving conditions. But that would probably be the most flexible because it's a multi-asset fund, and it can be long or short any asset class.
Thanks so much, Dave. The next question is on lumber. Do you think the correction in lumber is over? And if so, if it is over, what would you buy in exchange of that?
That's a great question. So let me just share my screen here. Funny you mentioned that. This is an alert on the wood ETF. I'm long this in the macro portfolio because much like some of the other commodities, now this is share prices, okay? It's not lumber itself. It's companies within the forestry sector. Was in a consolidation from May, came down, tested the 200-day moving average, tested it again at a higher level, and has turned higher. So I think this is kind of interesting. There is the CUT ETF, which is more timber related. So it's a little bit more focused on lumber. And this is an ETF that you could take advantage of here. I think that the correction in virtually all of these commodities is probably very close to an end. If the market starts to sniff out the fact that we're seeing a peak in this fourth wave, then I think it's very likely you're going to see these commodity prices go higher. Now, I didn't put on the screen, but dry bulk shipping rates have hit a new high. So there continues to be very tight shipping conditions. But I think that the demand for these commodities continues to be quite strong. And this is an area that I think, you know, could be a place that people could focus in.
Thanks so much, Dave. Well, that concludes the questions we've received this afternoon. As always, I'd like to thank you for taking the time to walk us through our strategy and how we're looking at the market and how we're shaping our thesis accordingly. Dave, as always, I'll leave you with the final word.
Yeah, I just want to throw just a couple of things up here just for people to keep in mind. You know, there's the bank ETF, 2008, a breakout at the end of 2020, and a test of the breakout point. This is nowhere near the end of anything. That's the beginning. If I take one of the major commodities producers, Rio Tinto, after having a tenfold increase in price after breaking out of the last bear market in commodities, was in a bear market effectively from 2011 through 2021, 10 years. It's a very large reverse head and shoulders, broke out, and has pulled right back into that breakout point. That's the beginning of a new bull market. When we look at some of the global markets, they look the same. I know I continue to put these up, but I don't want people to get bored. You know, when things consolidate, it takes a little while. But I think it's really important to know that we need to be invested in the place that investors will go to, not where they are already. And I think that the large cap tech stocks will continue to grow, and they have a wonderful outlook, and we want to have some exposure. Or we think the very, very good risk reward is in some of these groups that have been out of favor for a very long time and really are only at the beginning of their journey. So with that, Pam, we can wrap it up for today. Thanks so much.
Thanks, Dave. Have a great week, everyone. We'll see you same time, same place next Tuesday afternoon. Have a good evening.
Thanks for tuning in.